throughout the call. We'll also be able to unmute your line should you prefer to ask your question live. With that, I will go ahead and turn the call over to Julia Gordon for our NCST update.
Thanks so much, and good morning or afternoon, everyone, depending on where you are. We are, as always, delighted to have you with us for this call, and we once again are able to bring you some really interesting information from outside of NCST. But I do want to start with an update. So it's been quite a couple of weeks since we last spoke to you out there in the world. In addition to our continued efforts to deal with the coronavirus and the shutdown associated with that and the economic issues associated with that, the past couple of weeks have really shined a light on the systemic racism in our system and the importance not only of opposing police brutality and changing the way the police operate in our country, but more generally shining a light on issues of inequitable treatment and inequitable access to economic opportunity, healthcare, etc. NCST has released a statement that, as many organizations have. If you didn't see that statement in our email, you can find it on our website under the news item link, and happy to discuss the statement with anybody who has any questions about that. We also have, since our last call, had a really interesting webinar that if you were not able to join, we are happy to discuss with you whether we can get you some information about the webinar. On the webinar, Pete Carroll from CoreLogic presented a very preliminary view of a tool that they're creating that uses geospatial visualization tools and really extensive parcel level data and analytics to enable developers to locate neighborhoods and parcels that fit their goals for affordable housing development. It's a very extensive tool that also includes the ability to simulate a financial pro forma and trade-off analysis. I probably speak for all of us when I said that, seeing this tool, we felt like it could be of enormous use to many of you. Unfortunately, we can't post the video of that webinar because it is at such a developmental point of view at CoreLogic and is proprietary right now. But if you didn't see the webinar and you're interested, please reach out to David Sanchez on our staff to see if we can hook you up directly with Pete or get you permission to see that video. Over time, NCST will be remaining in conversations with Pete, and the hope is when they complete the use of this tool, we'll be working with Pete to find that there's to find out if there is a cost-effective way to make that tool available to developers such as yourself. So that was, that was an exciting webinar for us, and we look forward to seeing what comes of it. So I will speak later on the DC policy update because we really want to get to our speakers today. I believe our speaker from the Capital Magnet Fund and the CDFI Fund is going to be Eddie Tsibulevskiy. Sorry if I mangled your name. We're very appreciative that you've come here to talk to us today about the Capital Magnet Fund, and I'm just going to turn it over to you at this point.
Thank you, Julia. Thank you for the kind introduction. My name is Eddie Tsibulevskiy. I work for the Capital Magnet Fund at the CDFI Fund. I am very excited to be here and to share about the Capital Magnet Fund and how the CMF may work for you. So hopefully everyone is staying safe and healthy out there. And I think we'll have some time for a Q&A at the end. And I think the presentation will take about 25 minutes or half an hour or so. So with that, can we go to the next slide, please? Excellent, thank you. So in terms of the agenda, first, I'm gonna provide an overview of the CMF program, the background, our priorities. Then I'll talk about the eligibility and the different CMF applicant types. Hopefully this can help some of you decide whether or not you are eligible to apply and whether or not you're interested in applying for the 2020 round. I'll then talk about the CMF program requirements, application components and deadlines, and I'll finish up with some resources and how you can contact the CMF team. One thing I wanted to highlight is that our 2020 application round is currently open. We will host 2 application webinars. One will be tomorrow, 2 to 4 p.m. Eastern Time, and it's specifically targeting affordable housing developers. So if you're a developer and you're interested in applying and learning more about CMF, we strongly encourage you to call in tomorrow. All of the call-in information is available on our website. If you go to cdfifund.gov, click on CMF, and then click on Step 2 Apply, there's going to be information on how you can call in for the webinars. And then the second webinar, application webinar, will be next Tuesday, June 16th, and it will focus on financing entities. So I think with that, we can dive right in. Next slide, please. So overview of the CMF, thank you. So as most of you probably know, the Capital Magnet Fund was established through the Housing and Economic Recovery Act of 2008. We provide competitively awarded grants to both certified CDFIs and eligible nonprofit organizations. Our main priority is to attract private capital for an increase in investment in development, rehab, preservation, and purchase of affordable housing. It's both for homeownership and rental activities. It is targeted to low, very low, and extremely low families. And also, CMF allows applicants and recipients to undertake economic development activities that are designed to stabilize and or revitalize areas of economic distress. Next slide, please. So what are our priorities? Our main priority is to attract capital through CMF. So CMF serves as a pump. It primes the pump for affordable housing and economic development. For every dollar of CMF funding, recipients are required to generate at least $10 in eligible project costs. And that basically means the CMF award plus the leverage costs. And when we use the term leverage here, we're referring to the use of limited public funds to attract capital from other sources. So our priority, again, is to attract private capital for affordable housing and economic development. And CMF funds can help to attract investments from banks, foundations, private investments, as well as state and local governments. Next slide, please. We have some additional priorities. One of them is around affordable housing. So affordable rental housing, where 20% or more of CMF-supported rental units are targeted to very low-income families. So that's 50% of AMI and below. And for affordable homeownership, where 20% or more of CMF-supported homeownership units are targeted to low-income families, so 80% of AMI and below. In addition to affordable housing priorities, we also prioritize areas of economic distress, metropolitan and rural areas, and states and territories not served in the previous rounds. This is outlined in the NOFA, the Notice of Funds Availability. You can find that on our website, but these states include Alaska, North Dakota, South Dakota, as well as American Samoa, Guam, the Northern Mariana Islands, and the US Virgin Islands. So in short, applicants that address any of the CMF priorities will score more favorably. Next slide, please. So I wanted to take a minute or two and talk about some of the results from our previous round, the 2019 round. So in that round, we awarded $130.9 million to 38 recipients. We had 113 eligible applicants that requested more than 522.3 million in awards. So as you can see, we are significantly oversubscribed. And those 38 recipients consisted of 23 certified CDFIs and 50 nonprofit housing organizations. And the 38 recipients are projected to serve 46 states and territories around the country. So we have a very broad geographic coverage. In terms of attracting capital, the recipients projected to leverage $4 billion in public and private investment. Most of it will be generated by private investment. 79% of the leverage of the capital is projected to come from private investment. Next slide, please. So in terms of affordable housing production, these recipients projected to generate more than 22,000 affordable housing units. Those will be developed, rehabbed, or preserved. The vast majority of them will be rental units, more than 20,000, and more than 1,700 will be homeownership units. We do tend to get more rental applicants, but both homeownership and rental are eligible activities, and there's no advantage of proposing one over the other. In terms of income targeting, 100% of the homeownership units will be developed for low-income families. So that's 80% of AMI and below. And 58% of rental units will be developed for very low-income families, 50% AMI and below. And then in terms of areas of economic distress, 67% of units will be located in areas of economic distress. And for each round, we have a data set that's published on our website that indicates whether a census tract meets the criteria for an area of economic distress. And for 2020, that data set is on our website. You can check it out. 50% of our awardees, 2019 awardees, plan to invest a portion of the award in rural areas. And then 8% of awardees projected to undertake economic development activities. Okay, next slide, please. So the next section is going to cover eligibility and CMF applicant types, and hopefully it can help you guys decide if you're eligible and whether or not you're interested in applying. We certainly hope that you decide to apply, but hopefully this section will provide some more insight. In terms of eligibility, to be eligible, you have to be either a certified community development financial institution, a CDFI, or a nonprofit organization with a principal purpose of development or management of affordable housing. In addition to that, all applicants must have been in existence as a legally formed entity for at least 3 years prior to the application deadline. All applicants must also submit audited financial statements for the most recently completed 2 fiscal years as of the date of the NOFA. One thing to note is that all applicants must meet all of the eligibility requirements on their own behalf, and may not rely on any affiliates or subsidiaries to meet this requirement. Next slide, please. So there are two types of CMF applicants. So we talked about certified CDFIs and eligible nonprofits, and that's the eligibility type. And then we also have the applicant entity type, as you can see in this table. So all of the certified CDFIs are deemed as financing entities. Eligible nonprofits that are not CDFIs can either be financing entities or affordable housing developers or managers based on the predominant activity. And so eligible nonprofits will select their entity type depending on whether they're primarily providing financing or they are developing housing themselves. And then the webinar tomorrow as well on June 16th will really go into details how these application types are relevant for each applicant. Okay, next section we'll talk about the program requirements. Next slide, please. So the CMF program is extremely flexible and versatile. A number of different activities are allowed. And I'm just going to go through them, and I also want to provide some examples from the 2019 round of some of our recipients that undertake homeownership activities, since it sounds like most of the folks on here undertake homeownership activities as well. So hopefully it will give you some ideas of how flexible the program is. So eligible activities include capitalizing an affordable housing fund, capitalizing a revolving loan fund, funding loan loss reserves, making risk-sharing loans, providing loan guarantees, and capitalizing a fund for economic development. We see less risk-sharing loans and loan guarantees, although they are eligible activities. Most applicants do tend to propose to capitalize an affordable housing fund or a revolving loan fund. Okay, so I wanted to give you just a few examples of the 2019 recipients that undertake homeownership activities. So Twin Cities Habitat for Humanity was a 2019 recipient, and they plan to use their CMF award to provide construction and permanent financing to low-income home buyers in Minnesota. So basically to build and to finance homes. Massachusetts Housing Finance Agency, another 2019 recipient, will use its CMF award to provide down payment assistance for low-income home buyers in Massachusetts. Resident Ownership Capital, also known as Rock USA Capital, will use its CMF award to provide financing for homeowners in manufactured housing. And specifically, they help owners acquire the land that's beneath manufactured homes through resident-owned cooperatives, and they will serve 10 states across the country. Atlanta Neighborhood Development Partnership, another 2019 recipient, will use the CMF award to acquire, construct, and rehab homes, as well as to provide down payment assistance to low-income families in Georgia. HomeWise will use its CMF award to provide deferred mortgages for low-income families in New Mexico. And then I also wanted to provide two examples from the 2018 round. Housing Partnership Fund, which some of you might be familiar with, was a 2018 recipient, and they will use the CMF award to provide pre-development and acquisition financing, as well as bridge equity for rental housing in Detroit. And Grow South Dakota, a 2018 recipient, will use its CMF award to provide purchase assistance for low-income home buyers across South Dakota, and with a focus on areas of economic distress in particular. So hopefully this gives you a better sense of how the CMF program can be used. Next slide, please. Okay, so there are some CMF requirements and some limitations. that you should be aware of. The minimum award request is 500,000. You cannot request an amount below 500,000. By statute, the maximum award amount is 15% of the total CMF amount available for the round. For the 2020 round, the maximum award request is 26 million. Historically, our awards have ranged from $500,000 to roughly 7.5 million, with the average award being around 3.5 million. So even though the maximum award request can be 26 million, the average award sizes tend to be much lower. Each CMF award must result in eligible project costs, which is the CMF award dollars plus leverage costs. And they must result in at least 10 times the amount of the CMF award. For example, if the applicant is requesting a $1 million award, it would need to leverage another 9 million, resulting in 10 million of eligible project costs. And recipients may use no more than 30% of their award to finance economic development activities. So in this presentation, I'm not going to go into too much detail on economic development activities, since it sounds like most organizations undertake home ownership. But in the two application webinars, the one that's tomorrow and the one on June 16th, we're going to go into detail around some of the requirements for economic development activities. Next slide, please. No more than 5% of the CMF award can be used for direct admin expenses. And any portion of the amount that's available for direct admin may be used for direct costs to track and evaluate the program or evidence-based outcomes for CMF-assisted projects. This is a priority for us, so recipients are allowed to use their direct admin expenses to basically track outcomes and to evaluate the performance and impact of their program. Next slide, please. Attracting capital, we mentioned that we talked about attracting private capital is one of the most critical priorities for CMF, and recipients are required to leverage the award at a ratio of 10 to 1. For example, an award of 5 million must finance and or support projects with at least 50 million in eligible project costs. In terms of sources of capital, CMF awards may be loans from banks, program-related investments from foundations, LIHTC, funds contributed by the recipient, state or local government, or any number of private or public sources. So CMF awards are extremely helpful in attracting additional capital. And the combination of the CMF award and the leverage costs comprise the eligible project costs for the CMF program. Next slide, please. Private and public leverage sources. Public sources of leverage are typically grants, loans, or awards made to the applicant or project with funds that are allocated by federal, state, or local governments. Please note that cost financed or supported by the recipient's award or allocation from another CDFI Fund program cannot be counted as leverage costs for the CMF award. Private sources, most of the applicants' sources are going to be private, and that's leverage that refers to investments or loans from private third-party entities. Some examples include private activity bonds, LIHTC equity or other equity investments, lines of credit, loans, or other investments from private sources such as banks, private investors, or philanthropic entities that are made to the applicant or project. For regulated institutions, deposits are also considered private. Next slide, please. So there are 3 ways to leverage the CMF award, and I'm briefly going to touch on each one. The application webinars will go into much more detail. So the first one is enterprise level leverage. The second one is reinvestment. And the third one is project level leverage. Next slide, please. So enterprise level capital, also known as enterprise level leverage, is capital that is earned, borrowed, or raised by the applicant, which is designated for the applicant's use and is ultimately used to pay for leverage costs, but is not initially restricted for use for specific properties at the time it is earned, borrowed, or raised. So that's a lot of words, but basically it's capital that is raised or earned that's not restricted to a specific project at the time it is earned or raised. Enterprise level leverage can either be private or public. So, you know, an example of enterprise level leverage could be an organization's retained earnings or a PRI. And then a subset of enterprise level leverage is new private capital, which is an evaluation criteria that's outlined in the NOFA. And that's private capital that's raised or projected to be raised by the applicant after January 1st, 2020. And again, it's a subset of the overall enterprise level leverage. So another way to think about enterprise level leverage, it's capital that's attracted to the organization that's not restricted to a specific project. Next slide, please. Thank you. The second type of leverage is reinvestment leverage. And reinvestment leverage is basically redeploying repaid proceeds of CMF award dollars and or any enterprise level capital during the 5-year investment period. So it may not be applicable to some applicants that provide long-term financing, but to applicants that, for example, do pre-development or construction financing and expect to have those loans repaid within the 5-year investment period, this would be applicable. There's also a requirement that recipients of the CMF award will be required to reinvest principal and repayments of the CMF award into eligible activities during the 5-year investment period, and only those projects that will be completed during the 5-year investment period should be included as part of the reinvestment leverage. Next slide, please. The third and final leverage type is project leverage, which is probably the most familiar to developers. It's capital raised or earned that is restricted to a specific project at the time that it is raised, and it will be used to pay leverage costs. So LIHTC, for example, or a bank loan would be examples of project loan, project leverage capital. Okay, next slide, please. So CMF awards can be used to finance both rental housing and homeownership. Rental housing may be multifamily, 5 or more units, or it can be single family, 4 units or less. And while most rental housing is developed as one property, scattered site development is permitted. As I mentioned, most of our applicants tend to propose rental rather than homeownership. Some propose homeownership and others propose rental and homeownership. Again, there's no advantage to proposing one over the other. It's really about the business strategy and the quality of the strategy. Homeownership is usually single family housing. Homeownership may include single family detached, condominium, cooperative, and manufactured housing. Some recipients use the CMF award to make direct mortgage loans, purchase homes in order to sell them to qualified home buyers, or to establish a loan loss reserve for loans that they made using their own capital. Next slide, please. Okay, requirements for affordability. So for housing that's assisted through a CMF award, affordability must be met in several ways. The first one is income limits, and the maximum income level for a family may not exceed 120% of AMI for units financed with eligible project costs. So anything up to 120% of AMI is fine. Anything over 120% AMI would not be an eligible project cost. There's an additional requirement in terms of percentage of costs, and that is 100% of the eligible project costs must be attributable to units that are restricted to families at incomes of 100% AMI and below. And in addition to that, greater than 50% of the eligible project costs must be attributable to units that serve low, very low, and extremely low families. Next slide, please. There are some additional income targeting requirements. This may not be applicable to most folks, since if you're doing home ownership, this is not going to be applicable. But in case anyone is doing multifamily rental project, there is a project level requirement that's from the reg. And basically it stipulates that at least 20% of the units in each multifamily rental project must be affordable to and occupied by low-income families. So 80% of AMI and below. Okay, and then the portfolio level requirement applies to everyone, to all applicants and all recipients. Basically committing to a greater percentage of units for low-income families for homeownership, and or very low income families for rental is encouraged. Applicants basically indicate the percentage and the income levels they intend to serve in the application, and then they are held to those percentages in the assistance agreement. And this is measured at the portfolio level at the end of the 5-year investment period. So this is not a project level requirement. It's at the CMF portfolio level. Okay, next slide, please. Okay, there are some long-term restrictions with the CMF program. Each project that's funded must ensure affordability for the associated affordable housing for at least 10 years. For rental housing, this is accomplished through deed restrictions, land covenants, or other mechanisms that survive sale and transfer during the affordability period. For homeownership, the recipient must develop its own plan for achieving this 10-year affordability in the event of resale. So this is usually done through board-approved resolutions. Okay, next slide. Rents control affordability and are set using a formula that's similar to LIHTC. We can provide additional guidance if needed. The one that's probably going to be applicable to folks on the call is the homeownership cost limit. This is a reg requirement. The purchase price limits for homeownership are capped at 95% of the median purchase price for the area as determined by HUD. HUD publishes an annual data set with the purchase price limits. And so you have to make sure that the sale price does not exceed the 95% of the median purchase price. Okay, next slide, please. Okay, next, I'd like to talk about the application components and some deadlines that are coming up. Next slide, please. Okay, so there are 2 critical deadlines that are coming up very soon. If you're interested in applying, please keep them in mind. The first deadline is June 26th, and it's the deadline for submitting the SF 424 mandatory form. And that form is submitted through grants.gov. So even if you're not sure about applying and submitting the AMIS application, we strongly encourage everyone to submit the SF 424 by the deadline, by the June 26th deadline, because that will give you the option to apply and submit your AMIS application later on. If you don't submit the SF424 by the June 26th deadline, unfortunately, you will not be able to apply and submit the AMIS application later. So the online application and required attachments are going to be submitted electronically through AMIS, and AMIS stands for Awards Management Information System. Hopefully, some of you are already familiar with it. The deadline for submitting the AMIS application and all of the required attachments is July 27th, 5 p.m. Eastern Time. And again, all of these deadlines are outlined in the Notice of Funds Availability, which is available on our website under CMF Program. If you're new to AMIS and you have not created an AMIS organizational account, you also need to do so by July 2nd. It's fairly easy to do, and we can help you with that as well. But just keep that in mind. The last day to contact CMF staff with application-related questions is July 23rd, 5 p.m. Eastern Times. Any questions that received after that that time will not be answered until after the application deadline. Okay, next slide, please. This is just a high-level overview of what the AMIS application contains. These are the components. Again, the application webinars that will take place tomorrow and next week, they'll go into detail what each question is asking, and we'll provide some notes and guidance that's also in the application instructions. So basically, you're going to complete the applicant information, business and leveraging strategy questions, community impact, organizational capacity, appendices that are related to the 3 sections, and then you're going to submit attachments that are required. And that's basically it. Next slide, please. Okay, last but not least, I wanted to go through some resources that are available for anyone interested in applying for CMF. Next slide. Thank you. So if you go to our website, cdfifund.gov /CMF, and you click on Step 2 Apply, it will take you to the CMF site, and you will be able to access a number of important documents. So these are the documents that we strongly encourage you to review, and hopefully they will help you decide whether or not you want to apply. The first one is the CMF outreach presentation. The second one is training modules. We posted 6 modules on the Capital Magnet Fund, and they go into detail on CMF eligibility, affordability requirements, restrictions, and there's a lot of detail in those modules. The next one is the CMF interim rule. These are the regulations for the CMF program, and these are really important. So if you're considering applying, we strongly suggest that you review those. And then we also posted the Notice of Funds Availability, which is known as the NOFA. The NOFA contains all of the deadlines. It also contains all of the evaluation criteria. So it's critical to review that. The application instructions outline all of the questions that you will be completing in AMIS. There's notes and guidance for each question. And the application instructions also contain guidance on how to submit the SF424 in grants.gov. So hopefully that's helpful. Application FAQs. These are the most frequently asked questions over the last few rounds. We find them very helpful. If you have a question, we strongly suggest checking the application FAQs first. We also have the CMF glossary with all of the key terms. And then last but not least, there's a data set that contains the economic distress census tracts, rural and low income area data set. So in the application, there are questions about, the percentage of units that will be in areas of economic distress, for example. And so you can refer to that data set to figure out whether, a property or project is located in a census tract that is considered an area of economic distress. And same thing with rural area. For each census tract, there's a column indicating whether a census tract is in a rural area or not. Okay, next slide, please.
Say, Eddie, I'm not sure how many more slides we have. I want to be respectful of your time as well as have some time for questions.
Yeah, this is the last slide.
Fantastic.
So yeah, this is just 3 ways to reach us. You can submit a service request in AMOS. You can call us at the help desk, and you can email us. There's the email address right there. The best way to reach us is probably through service request or email. We monitor those throughout the day. The next slide just contains information on how to submit a service request. I don't know if that's helpful or not, but and that's all I have. So I'm happy to answer any questions, and hopefully this was helpful.
Wonderful. Thank you so much for that breadth of information. I'm hoping that some of our partners will be able to take advantage of these available funds. With your permission, we'll go ahead and upload this presentation to our resources page so that folks can acquire the information about attending additional sessions, as well as be able to follow the steps that you've outlined here.
Yeah, that would be great. Thank you.
Fantastic. We'll go ahead and do that for all the folks on the phone. So a couple of questions that we've got from folks. As a reminder, you can utilize the Q&A feature or the chat feature. You can also raise your hand and we can unmute your line. First one is, do areas of economic distress and rural include tribal lands?
So tribal lands is not a specific criteria for an areas of economic distress, but they do look at poverty rates, underserved rural areas, light tech qualified census tracts, and other criteria that's outlined in the NOFA, as well as vacancy rate. So chances are that a lot of tribal census tracts will be considered areas of economic distress. You would have to refer and check the data set and check the specific census tracts. But my guess is that in general, many of the tribal census tracts will qualify as areas of economic distress.
Great. Second question is more about the application scoring. Is it scored overall? Is it based on a point system? Is there any additional information you can share about that?
Sure. Yeah, great question. So the NOFA provides the evaluation criteria, and it talks about the 3 different sections and how they're scored. Each section has a number of points outlined. So, I think the business strategy is, I think 40 or 45 points. Then community impact is, I believe 30 or 35 points, and organizational capacity is 25 points. So all of that information, again, is in the NOFA, and for each section, the NOFA specifically outlines what are the evaluation factors for that specific section. So for example, for business and leverage strategy section, it will talk about how the attracting private leverage is an evaluation criteria. So it's fairly detailed and very specific.
Wonderful. We'll go ahead and refer folks to that NOFA then. Last question for today. Are Bank Enterprise Awards or Federal Home Loan Bank AHP Awards considered project leverage?
So that's a good question. Again, if those funds restrict the use to a specific project, they would be considered project level leverage. With bank enterprise awards, I'm assuming you're referring to the CDFI funds, bank enterprise awards. You just have to be careful that you can't use other CDFI fund programs as leverage for the CMF program. So you can't count that as leverage.
Got it. Well, I want to thank you again. Those are all the questions we have right now. I want to thank you again for your time this morning and for this information. Again, if folks are just joining, we will go ahead and upload your presentation to our resources center on our website. At this point, you're welcome to stay on. I'm going to turn things back over to Julia Gordon for a policy update.
Great,
Thanks so much, Erin, and thank you again, Eddie, for that fantastic and very thorough presentation. I think that'll be really useful to everybody on the call, and we will have it up on the website, as Erin said, so that that you can go back and review, since it was so much information. I do want to leave a little bit of time for discussion, but I wanted to provide a couple of quick policy updates from the regulatory perspective. There is not much to report right now on legislation. We've previously discussed the HEROES Act that was passed by the House. That continues to be a topic of discussion in the Senate, but we don't have a real sense right now of timing or exactly what the configuration of any particular bill would be. There is particular activity around the $100 billion for rental assistance, which is, obviously needed fairly desperately in lots of places, as well as continued conversation around other support for homeownership and foreclosure prevention. I do want to mention two regulatory developments. The first, I'm not going to go into details, but it is relevant at a broad level, which is that the Federal Housing Finance Agency, which regulates Fannie Mae and Freddie Mac, has issued a proposed rule with respect to the amount of capital they will require Fannie and Freddie to raise in order to come out of conservatorship. So this is very relevant to the future of these government-backed loans and really the future of housing finance across the board. Again, it's an extremely detailed proposal, very much in the weeds. I'm not going to say much about it other than it does require the enterprises to hold quite a lot of capital, significantly more than they have now, and very significantly more than they've ever been required to hold in the past, which we expect would have not only an effect on pricing, but probably an effect on the Fannie and Freddie footprint in the market as a whole. So that's something relevant that we'll be keeping an eye on and likely providing some kind of regulatory comment response to. The second, and I think of more immediate and urgent interest to everybody on this phone call, is we've talked previously about what FHFA did to deal with loans that go into forbearance between the time they're closed and the time they're delivered into Fannie and Freddie pools. FHFA imposed a loan level price adjustment of between 500 and 700 basis points. FHA has recently come out with their answer to this same question: what to do with loans that go into forbearance after they're closed, but before the FHA insurance is put on them. And the answer to that is, for any of those loans that were to go delinquent or go to default within 2 years of making the loan, FHA is going to require the lender to indemnify them for 20% of that covered amount. While the 2 years is, not a terribly long period, 20% indemnification is obviously extremely high, particularly relative to the FHFA LLPAs. And what we are hearing from lenders is that if this goes into effect, it's going to significantly chill FHA lending. Most of you who are trying to sell houses are already aware that the FHA credit box has been narrowed by many FHA lenders. It is tougher and tougher for anyone under 680 FICO, and in some cases even under 700 FICO, to get an FHA loan. And this is going to further impair that FHA credit box. So there is a fairly widespread and coordinated response from the lender community and from the realtor community. And we are also planning a response from the nonprofit community. And so, keep an eye out if we circulate any more information about that. But if you have any more questions, feel free to reach out to us about that at any time. So I'm going to stop there because we only have a few more minutes. Back to you, Erin.
Sounds great. Thank you. We can certainly take questions, but really at this point, we want to hear from you. We haven't had time to get local updates over the past several weeks, and we have three kind of burning questions on our mind. First one is, how are your markets doing? Are they feeling more back to normal? Second question is around sourcing inventory and how able you've been to do that given foreclosure moratoria or other factors. And the last question is, for those with a rental portfolio, what are you seeing these days in terms of rental payments? Feedback can be given in a couple of different ways, certainly through the Q&A, through the chat, or I'm more than happy to hear directly from any of you if you want to utilize the raise your hand feature. Got a hand raised here. JR, I've unmuted your line.
Hello, everybody. Thanks again for the call. I can speak to the rental market in terms of what we've been seeing. There's been a lot of programs out there to assist landlords with subsidies for rent. So we've been fortunate enough to grab some resources thus far from a national group, the National Low Income Housing Coalition, to keep our emergency housing and transitional housing going. We've been able to grab resources from the city of Chicago. And some of the suburbs, like I said on the last call, they have waived reoccupancy waivers until they open back up. So if we were already in the midst of fixing up our house and working on the house, then we can go ahead and rent it out without having to have the occupancy permit or registration on file.
Thank you for that, JR. That's extremely helpful. Michael, wonderful news that New York is starting to get back to normal. Absolutely great to hear. Additional feedback from folks? Let me see if I missed something here. Inventory is still a challenge, it sounds like, in New York. We're absolutely seeing that. We're getting feedback from others as well that through our portal and just out in the market in general, inventory has been very slow.
I can briefly update people with respect to the GSC moratoria, which is while that moratorium does expire at the end of this month, in testimony in Congress yesterday, Director Calabria suggested that it is likely to be extended either 1 or 2 more months, and we'll hear about that in the next week or so.
Julia, just in the chat, even it looks like inventory continues to be a challenge in many areas, Detroit as well. Additional folks with local updates for us this week? Not seeing any hands raised. Our Q&A looks to be good. With that, a reminder that we will have a call again in a couple of weeks, and I'll turn it back to Julia Gordon for final remarks.
Thanks, Erin. And again, thanks to everybody for coming on the call. Just a reminder that we do need to hear from you. You are out there in the field doing this real estate work. We're particularly interested in continuing to be updated about what you're seeing on the inventory side, what you're seeing on the access to mortgage credit side, and your home buyer side. Any concerns you have with respect to rental. I know not every locality is as on top of this as Chicago is. And so some of you may be in a slightly different position from JR. And, of course, any other items you think we should know that relate to the process of acquiring, rehabbing, and selling these properties. So with that, thank you very much for being with us today, and we'll look forward to talking to you in 2 more weeks.